Well, here we are. Hello, hello, and nice to see some familiar names on the chat. A couple of new ones too. Welcome, welcome, and thanks for grabbing some time this evening with us. Interesting conversation. Damien's queued up, ready to come in. But just before I do that, we should just visit Doggy Cam, I guess, just because we can. They've been sound asleep. I've had 4 walks today, so they're pretty much flat out now. And, of course, enjoying the last few weeks here in Australia before we return to the UK for a period. So it's all very much happening and quite exciting, a lot going on. You may have seen my show over the weekend when I showed a little bit of view of the Bath property that I've bought. And essentially my view is that it was time to make a move, go back to the UK. And we'll still cover Australian surveys, Australian markets, still run the same sorts of shows. There'll be a little bit of a break for 3 or 4 weeks as I get everything packed up on the move, but we'll be back. And we have a few special shows teed up over the next few days just to draw it nicely to just a slight temporary pause. And I'll probably pop up from time to time with the occasional additional show too. Anyway, we can talk about more of that as we get going. And I've got a few questions that people have thrown at us already. And I'm sure there'll be others. And be plenty of time to explore all of those. So let me take the pre-show off. And I'm going to run the intro. We're back in just a moment. Well, hello and good evening and welcome to this live stream on the 28th of February 2023. Martin North from Digital Finance Analytics here. Great to have you with us and thanks for taking some of your Tuesday evening out to share it with us. And as always, very pleased to see all those comments in the chat and we'll certainly incorporate some of those in the show as we go forward. Before I just progress with Damien, let me just remind you, as I always do, that we don't provide specific financial, legal advice or even property advice, general conversation only. We do moderate the chat, so please play nice. And if you're watching the replay, this is on the 28th of Feb 2023. And this time in 4 weeks, I will literally be in the air to the UK. So it's not far now. If you would like to make a conversation point or to get my attention or ask a question, you use @WhatTheWorld. That'll make sure that I sit in my queue. And I've also enabled Super Chat, so if you want to get your questions over the list, you can use that, or if you'd like to make a contribution to what we do here, always gratefully received. Anyhow, without further ado, let me bring Damien in. Damien, hello.
Martin, how you going?
Yeah, pretty good. How are you doing?
Yeah, not too bad. Not too bad.
Can you believe it? It's a whole another month. Of course, it's a very short month this time, so it's literally just 4 weeks, isn't it? And,
yeah, that's right. It doesn't feel as if as much has changed this month. It feels as if we had a couple of really, really busy months where a lot changed as we spoke. But I feel as if it's been a little more stable in the past weeks. Although there's obviously a lot going on and a lot to talk about.
Plenty to talk about. And I reckon that the starting point should be the earnings question, right? Because there's been quite a few articles. I made a show on Saturday where people are saying you're forgetting that stock values are a discount based on future earnings flows, right? Because it's what's going to happen ahead.
Sounds like a crazy talk about Martin. You know,
I know. It's,
surely it's all about hopes and dreams.
It's hopium, right? Yeah. So,
yes.
so the point there is that if in fact forward earnings is actually lower, then that means the markets are well over perhaps where they should be. And in fact, I was quoting a couple of ratios that would suggest that it's pretty close to being stupid. What's your thoughts on it?
Look, the valuations are certainly high. So I've got a couple of charts. I'll let me bring up because the first one here. This is just I like to look at how forecasts change over time, and sometimes they're a little bit weird in terms of the way they go. But if you look at the blue line, for example, that's the first quarter earnings. This is US, but it's pretty close to the global numbers. Aren't significantly different. And so sort of it travels along its time and eventually ends up with 11% EPS growth. So different forecasts. And then so it had that big drop and then sort of a bit of a recovery. Things were better than what people had expected. Same thing happened again in Q2, and now we came in with sort of 9.8. Now Q3 was sort of down and down and down, and eventually ended up at 4%. Q4 we've ended up with negative numbers, so 0.7 roughly, but a little bit below. So things have certainly headed, getting worse as the year went on. Then we need to say, okay, well, what's happening now for actually I'll jump forward in one more for 2023 numbers. 2023 numbers have come down from sort of 10% down to 0, and that's I don't think that's far enough yet. Like that's basically saying things are going to improve basically from the fourth quarter. And then in 2024, analysts have actually been upgrading their numbers. Now, why are they upgrading the numbers? Well, this is one of those weird, more behavioural, in my view, than actual sort of positive view on 2024. And how it works is an analyst has a forecast for next year of 110, and then for the year after of 120. And then things look worse. They come out and they go, I'm going to have to downgrade my numbers. So let me downgrade the 110 from 110 to 105. I'll knock a little bit less off the second year. So I'll just go from 120 back to 118. And that sounds like a reasonable thing. Things are looking a bit worse. I'll knock a bit more off the coming year and lots off the year after. The issue is what you've actually done is in this you've taken the first year from 100 to 105, so it's gone from a 10% growth to a 5% growth. The second year you've actually increased the growth rate though, because now you've brought down the first one and not brought down the second one as far. So you've actually sort of forecasting a higher number. And if you notice, this has got a line of a bunch of these other ones. In the bad years, that happens almost all the time. So you get like this. This blue line here where there's a bit of a rise in the 2013 as the 2012 got, and then eventually you get closer and it comes down. And then the same thing happens in 2014 and the same thing happens in 2016. And, anytime there's a bad year, you usually see a bit of an uptick in earnings, the second year earnings. And then once people actually start paying attention going, oh, actually now I'm forecasting, 14% growth, that's not going to happen. And so, If you smooth it out, then, and this is sort of looking at a bit of a longer term one from this is from Morgan Stanley, and just sort of showing that when earnings are falling, usually you see prices falling as well. And so just sort of during that 2008 period, you saw earnings fall most of the time. We had earnings sort of drifting off the 2015 and prices coming back as well. There's a little bit of an argument that sorry, this is the next 12-month numbers. This is like a rolling sort of figure. There's a little bit of an argument out there that people are talking about saying maybe earnings have hit the bottom and we've seen enough downgrades. That would be surprising if that were the case. If you look at, there's a number of different people, and I've used the Morgan Stanley one, but there's a whole bunch of other people who sort of run these same sort of quantitative models where they basically throw a whole lot of factors in together, and most of them are types of things about either CapEx, capital expenditure surveys, or forward-looking expectations, and so a lot of the sort of future types of factors. And almost all of them come out to these models. And this one's got one that's sort of suggesting that, so the blue line is the actual earnings growth. The dotted line is where their model thinks it's going. And the yellow line is where analysts are currently forecasting numbers. So you can see there's a massive difference between what analysts are forecasting and what these leading indicators are saying. Now there's a reasonable argument that maybe these leading indicators are a bit too pessimistic at this point, but I guess it's a question about saying, well, if earnings are effectively back to zero for forecasts at the moment, they don't need to fall to whatever this is saying, almost not minus 30%, for it to be pretty devastating for the market. I think if you got a 10 to 15% downgrade to earnings, I think the market's going to take a big hit because it is a little bit expensive right now.
Yeah, and of course, the really interesting nexus was the change in the Fed expectation, right? So the markets were pretty much saying the Fed's close to easing off. And then the Fed came out and said, no, we actually are seriously worried about inflation. Some of the data indicators were more aggressive with regards to where the economy was going. So the economy is not dampening down as quickly as effectively as perhaps the Fed was thinking it would. And so now the forward expectations about inflation do seem to be more aggressive. And that means that the Fed is now, well, some people are saying even 6%. Jamie Dimon, I think from Citigroup, said 6% is by no means off the cards.
Yeah, that's right. And so, and the question is, what does that mean for the rest of the economy? So, I guess there's the thought process goes out there that central bankers would like to be the person who cured inflation rather than the person who let inflation, get free. And so the question is, are they prepared to put the economy into a deep-ish recession? Which is what Paul Volcker effectively did to kill inflation, in order to get there. And so, I guess if your view is that no, they're going to change their mind and they're going to reverse, really quickly, then you'd probably be more bullish on equities and be keener to buy at the moment. If you think they're going to say if they're going to do what they say they're going to do, then you should be extremely bearish. And it's sort of this market sort of pricing it somewhere in between that. They're basically saying, well, they're not going to do what they say they're going to do. That'd be crazy. That'd crash the economy and
break things.
Break things. And so the market's sort of been pricing for a while now that they're only going to do half of what they say. And then the question is, well, maybe what if they do 3/4 of what they say? They're still certainly not priced in for if they do what they say. And again, I don't think they'll do what they say, but I don't know. It's a yeah.
So is it a double bluff? What I mean by that is what they're doing is basically jawboning, right? So that the markets, react to it, and maybe they don't need to do it because they've said they're going to do it. Well,
a little bit, and it's actually there's almost a bit of the opposite effect as well in that because they haven't been jawboning enough, and they've sort of been saying about, well, maybe things are cooling down and trying to talk a little bit positive. Markets have been, so stock markets in particular, rallied quite harder over the last few months, and that's actually quite a big factor in their financial conditions index. And so it's almost a bit of a catch-22 in that the more markets go up, then the higher they need to put interest rates to bring down financial conditions, and so therefore markets should fall. And so there's there's certainly some reflexivity or something. It's not a it's not a you can't determine the one outcome without sort of looking at the other as well.
Yeah, absolutely. And that's the complexity is there are lots of different interactive elements, and then you've got the China situation, you've got the Ukraine situation, you've got all those sorts of things there. But of course, there's also an immediate flow on then to Australia, right? Because we're also seeing the same sort of stuff here, right? And so the question now is, well, what is it going to take? And in fact, there was a question which came in a little while ago from George. How far are interest rates expected to rise, and should we expect a soft landing and avoid a recession? I mean, that's the nirvana, and thanks for the super chat, George, appreciate it. That's the nirvana everybody's after. The question is it conceivable that you can actually have a soft landing and avoid a recession and put interest rates up? I mean, that's the sort of the dilemma, isn't it?
Yeah, well, and I guess the trending term over the last month has been no landing. It's this idea that people have got out there saying that, hey, maybe everything will just be fine. We'll never land, and we'll just keep going up, and the Fed will stop raising rates, and everything will be fine. Look, it's possible. It's possible to have a soft landing. It's just it's very unlikely. I think the big things. I guess two of my sort of core tenets of of how I see markets moving and economies in particular is that one is that fiscal policy works. So when they actually get out and governments throw money at people, especially direct transfers in terms of money, that works really well in terms of generating demand. And we saw that during the pandemic. Is governments went from not spending very much and sort of holding the fiscal purse strings quite tight to spending a lot of money, and we saw that sort of pick up in an economic boom. The other one is that on the monetary side, though, is that monetary easing, once you hit a certain level, doesn't really work. We saw that through a lot of the late 2010s, where we sort of saw cuts in rates, and it never really sparked demand, and it got it got debt up to much higher levels and things like that, but it was never really sparking this general demand. But I do think the opposite way works. I do think that when you raise rates, that does clamp down on the economy, and that increase in interest rates will have an effect. But it comes with a lag. And so the question with all this is we're still talking about, they talk about that sort of 6 to 18 months or whatever. And you go, well, interest rates first started rising, back in March sort of last year. So we're not even a year into this. And so the full effects really of the first rate rise really haven't flowed through. So, and actually, it's probably a good time before we jump too much into Australia. I wouldn't mind just touching on a couple of inflation charts as well. Sure. That I just wanted to sort of give this big picture view, and why this last set of data, there's some weird things going on that is worth considering about, and worth
not least some of the rebaselining they had to do, right?
Yeah,
that's a very important point. Yeah. Okay.
Okay. So I sort of look at it in 4 different chunks. So I look at the food, the energy, then there's services, and then the and the goods. So this is just a chart of food, and I know it'll be quite small for you, but the main thing is actually the colours. And the first sort of 3 lines is through to December 2019. So pre-pandemic, the 10 years, the 5 years, and the 3 years, and food was basically deflationary for most of that, except for what they call food away from home, which is restaurants. So restaurants was running at sort of 2 to 3% clip. And everything, all this other food was either basically flat or running at sort of even negative numbers over particular times. So a source of deflation. The next sort of chunk is through to January 2023, sort of annualized data, and that's looking at there's obviously lots of green showing there. Meat and poultry and fish have started to turn down in the last few months, so there's possibly some signs there. And if you look at some of the forward signs for food, they are getting a little bit better in terms of some of the UN food price indexes and things like that are actually looking a fair bit better. So there's possibly some good news on that front. But having said that, food gets excluded from most sort of central banks anyway. Energy. Look, I'm sure we'll talk about energy later. It's up and down. It's all over the place. It's much higher than it was, but it's fallen a bit recently. And then the latest month, we saw a bit of a tick up again. So, I think energy it's volatile. Let's just put it that to side, and it's pretty high at the moment. The more interesting one comes when you get to these goods inflation, and goods. It shows exactly that same trend. All red in the prior to 2019. Goods were a big source of deflation. Lots of green in that sort of middle section. But the thing is, we've been seeing these big splotches of red, and these are in the last 3 lines is November, December, and January. And in December, we actually started to see a lot of splotches of red. And I think that's where everyone got quite positive in terms of the outlook. And yes, things are moving the way we wanted to. January reversed that trend for a bunch of things. So windows and floor coverings, appliances jumped 1.4%, apparel jumped 0.8%, infant and toddlers apparel was up almost 4%. Miscellaneous personal goods, which is sort of things like there's a lot of like toothpaste and stuff like that, was all up sort of 3%. Like there's just a lot of weird things going on. Now, 1 month doesn't make it can easily be an aberration in a lot of these. But I think it's certainly put a little bit of concern in people who are looking at the goods going, yeah, everything's moving the right way. And then there's just a bunch of things that have popped up going, okay, we need to work out, is this a 1 month aberration? Is there something funny in the numbers? Or is there something here that's more ongoing? And the Fed is obviously, adopting a more cautious stance. And then the final one's in services where, services, a fair bit of that was pretty green beforehand. That was generally running at sort of almost 3%. Services inflation before the pandemic. It's been much worse now, although it was slower to get going. It's still running hot. Couple of signs that maybe it's slowing down, but big picture, it's still very, very strong on that services side. And so, the Fed strips out this thing called super core inflation, which is this new, you keep cutting things out, but it's basically core inflation, which is, that going, core services. This is a core services inflation, and then they exclude housing from it. And that's the one which the Fed says they look a lot at, and that's still running pretty hot in that last, the last, you can probably see on that last little bit, there was a bit of a tick up. The prior tick down was like, oh, it's all, it's coming off. It's all downhill from here. But that last little tick up is what's concerned the Fed and questions about, what happened in January. Why were consumers so strong in the US, and we saw it a bit in Australia as well. And
because the retail here was strong too, right? After a week previous month, but. With all of these things, is that anomalies in the data? Because, of course, it seems to me that things go up and down like a yo-yo around Christmas, holidays and everything else, right? So how much of it's data and how much of it's real? It's the real question.
Exactly. And I think the answer is a lot of it's just the data, weird stuff happening in the data, but I don't know. I'm not, and it puts an element of concern. I'm happy to take the bet it is elements of the data. And I do think as well that some of this, I guess, later on in the year data that you get, it is worth noting that, especially in Europe, there's been a big fall in energy costs, and it's a little bit around. I've got this chart up just showing that gasoline and other costs in January was sort of down 2% in terms of spending. Now that ends up somewhere. So if you were going to grow. So I guess what I'm saying is you've just saved $50 on your petrol bill that you weren't expecting. Maybe you go out and have another dinner, or maybe you buy something else that you weren't expecting to buy, or you buy something earlier. So there is that effect that I think probably did drift through into the end of the year somewhere, and quite possibly still in January, is that there's just a fall off in energy prices has meant that other places haven't done have done a little bit better, but all this. If you're a positive on this and it's all going to keep going, it's sort of saying you don't think that monetary policy works anymore, and that these rate rises we've had, sort of record speed and record rate, in terms of the percentage of GDP isn't going to work, and that people can take a 3-4% increase in interest rates and keep going. I don't think that's true, but it might be. I might be wrong. So.
And the point about that is, and Phil Lowe was before Parliament a couple of times, week before last, and he was making a couple of points. One is inflation's got to be crushed because it's crucial that it is, right? Which, secondly, the lever is interest rates because that's all they've got. And thirdly, they recognise that some people are actually going to be caught by this, but their argument is you've got to do it because otherwise everybody gets caught. So it's like when the only tool you've got is a hammer, right? Then the only solution is everything looks like a nail, so we'll just lift those rates a bit higher. And even in Australia now, the rates are actually expected to go quite high. NZ's saying another 3 rate rises, and they're calling house prices to slide. Some of the others are sort of a little bit more coy about calling higher rates, but just remember that a few months ago people were saying, the RBA, won't go much beyond February. Now they're saying February, March, May, maybe later.
Yeah, and look, I'm one that says I think they've done enough already, and we're waiting for the effect. They'd be better off waiting to see the effects of the prior rate rises. Having said that, I don't think they're going to. I do think they're going to keep raising rates. That's a question about what you think they should do versus what you think they will do.
Yes,
and I'm not I don't claim to have these deep insights. There's a lot of people, I guess, and especially a lot of the economists out there who worked at the RBA and sort of obviously know a lot of people and talk to them all the time, and that's not me. So they've obviously got better insights into the current thinking and everything. what I'm saying is, I think they've done enough. I think the US has probably done close to enough as well, but you won't see the effect flow through for the US for a bit longer because the way their interest rate works and the effect on mortgages. And I think later on this year, we're actually going to see quite weak inflation and quite possibly deflation, I think, in categories.
So you'd be in the sort of, they'll go up a bit, but then come down again quite quickly camp.
Well, I think they'll come down quite quickly. I'd like to hope they will, but I'm not investing that way. I'm investing as if they're going to hold it for a little bit longer, and it will take them a while to turn it around. Because I do think, especially in recent times, they've been talking up the whole. You got to get on top of exactly what you said about Phil Lowe. You've got to get on top of inflation. Can't let it get out of control. Could they reverse that in 3 or 4 months' time and turn around and say, oh, actually things have fallen a lot faster and unemployment's starting to rise quite quickly, and maybe we need to go the other way? Maybe not 3 or 4 months, but maybe 6 months. Yeah, maybe they could, but I think it'll take them. I think it'll take them 3 or 4 months of gradually slowing and telling people, hey, maybe we might think about this, and before they finally do. And they haven't started doing that yet. So if they don't start for another 3 or 4 months, and then that takes them to another 3 or 4 months, then and then you get the lag effect for that actually get kicked through.
And the lag effect typically is 12 to 18 months, right? In past cycles, maybe this time a bit quicker, but I'm not sure it will be. But what about this concept that a lot of the inflation is actually coming from corporates who are actually jacking up the prices more than they need? Because that made a big splash last week, right, when the particular report came out. Yeah,
absolutely true as far as I can tell. That's from the companies I look at. They complain about costs going up and inflation this and inflation that, and they're like, oh, our wages bill's up 5%, whatever, and well, sales was up 10, and we've increased our prices by 8, and so we've improved our margins, and margins have been improving for broadly speaking for most companies, and so, but this is the issue that in terms of investing that you need to look at is that. What's called value stocks are the ones that are usually quite cheaply priced. They don't usually have a lot of control over their margins. Say a tire company or something like that is like, yeah, okay, I care a little bit, but if it's Michelin or if it's Bridgestone or if it's whatever it is, if one of them's twice the price of the other, well, I'll buy the other one. Like I know the quality's not so different that you're gonna pay like too much extra for one versus the other. And so those types of companies generally struggle in normal times to keep their margins, and they're the ones that just have to keep, because their competitors keep their prices low, and so they have to keep their prices low, and they raise their prices and they lose a bunch of market share, and so that's their sort of lot in life. Late in the cycle, when you get these real economic demand and booms happen. And inflation, a bit of inflation, that's when they can finally increase their prices. And that's what they've done. They've all got out there and actually added to the prices. The question now is, as demand starts to weaken, will they cut their prices back down, or will they try and hold them up? And I look at the car industry as a great example of this. They are making huge margins at the moment. And it's a serendipitous sort of problem that they've all had. They haven't been able to produce enough cars because of the chips, I think pretty widely known, which has actually been really good for them because rather than 100 million cars, they can only produce 90 million cars around the world. Or if you're a car manufacturer and you instead of being able to produce 5 million yourself, you could only produce 4.5. But there's actually demand for 5 million. And so what do you do when you've got demand for 5 million cars, but you can only produce 4.5? Well, you jack your prices up till you can price a bunch of people out. And that's what effectively has happened to that entire car industry. They've all jacked their prices up to price people out. Now, they're talking about saying, oh, we're going to be much more disciplined now, and we're not going to go back to the bad old days of trying to produce more cars and cut the prices, and then everyone makes less money and blah, 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 blah. There's a lot of car companies out there, and I'm pretty sure they will. So, all you need is one or two, a couple of Chinese brands to say, well, we're going to pick up market share. We'll cut our prices, or Korean brands to say, yes, we're going to use this opportunity. Everyone else wants to keep their prices high, no problems. We'll put them back to the old prices and pick up another 10% market share. So so I guess what I'm looking at is they're the companies you don't want to be holding on to when as the tide goes back out again. The companies that put up prices and probably didn't need to, but just did it because everyone else was, they're the ones that you want to hold on to. Then that's what we sort of call the quality companies, the ones that don't have that issue. And partly the other thing you want is oligopolies or monopolies, because they're the ones that can actually just hold on to those prices. They don't have anyone really to compete, and there's only 2 or 3 other companies out there that and Australia is full of oligopolies, and so they put their prices up, they can keep them up.
Yeah.
I like to think that that the introduction of Audi into Australia, however many years ago, 10, 15 years ago, that probably benefited current inflation by at least a couple of points, because would Coles and Woolies have put their prices up even further if they could have? I don't know. Probably. Everyone's used to. It's the part where, and that is one thing you definitely hear when you're talking to companies about this, is that they just say people don't bitch and complain as much as they used to when prices come through, because they're used to it now. It's the part where they're like, oh, I've got a 5% price increase. They're like, what are you doing? You're increasing your prices 5%, blah, 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 blah. Whereas now it's like, oh, well, everyone else is increasing their price, And so,
it's interesting because I actually done some analysis in the supply chains as well, and producer prices, and I'm seeing exactly the same. So everyone's putting their prices up through the supply chain, and therefore when it comes to the end consumer or the end business, prices are quite a lot higher. And of course the other point of it, there's a thing called the base effects, right? So when you've had big increases in the past, they stick in the indices for 12 months and they drop out. Now, we are going to see some base effects dropping out over the next few months, which is one of the reasons why many people are saying it's definitely going to see inflation come down. Right, but that doesn't mean prices are going to drop. It just means they're not going to go up necessarily as fast as they were previously.
Yeah, exactly, and that's the important issue. Is there's some industries where the prices are going to go. They've gone up in a line. They're going to go. They might flatten out for a little bit and then keep going back to trend. So, but there's other industries like the shipping industry where prices went sky high and then they've fallen right back down again, and now they might go back to some sort of trend. But and the question is, how much of it's going to be the ones who are just like, okay, I managed to get through, a couple of 5 and 10% price increases. Now I've just got to sit tight for a year or two, and then I can start going again. Versus the other ones, which are, the car companies. What I think will happen to the car companies, which is they put their prices up, they're all going to start competing with each other, and they're going to bring the prices back down again. And so it's going to be a trade-off though, and there are lots of some of those will take longer. So. We did see a lot of panic, like that whole prices on shipping, because so many people panicked about, I may not be able to get the shipping I want and it's so expensive and all that type of stuff. They locked themselves in for quite long terms, and a lot of the shipping companies went, yeah, sure, you want to pay these rates for the next 2 years? Sure, yeah, done. And so, that'll, again, will come out, but the question will be, if you're in an industry where, so the price to ship from China to the US used to be, I don't know, maybe $2,000, less than $2,000 a container, went to sort of $12,000. It's back to $2,000 now. A bunch of the companies, they upped their prices because it went to $12,000. Now, will they just hold their prices where they are and go, oh, we managed to get that? Or will they have to bring it back down again? And that'll be the test.
So given the fact that we've got doubts about the value of equities and inflation quite high, bond rates are climbing again now. So what does that tell us about the bond market? And is that a safer place to be investing relative to the equities at the moment?
I believe so. So we've still got a fair chunk invested in bonds, and we bought some of the longer term ones sort of over the last at the last spike, higher in yields. Now it does come down though to your thoughts on if you're in the no recovery or the soft recovery, then no, you shouldn't be in bonds. Go buy some more equities, because if we're in a soft landing or a no recovery, then they're probably going to keep going. If you're of the view that it's going to get a hit and hit reasonably hard, then bonds I think are the right place to be. There is another sort of longer term question about, okay, if we do get a downturn, what's the reaction to it? Do central banks just go, yeah, okay, here's all this money, and governments turn around and go, hey, during the pandemic we gave all this money away and that seemed to solve it really quickly. Let's do the same thing again. And if that happens, then we're back to inflation and bond yields are probably going to really rocket, and you don't want to be anywhere near bonds at that point. But I think for the next sort of 12 to 18 months, because we really won't know, until that period, I'm expecting quite weak economic conditions, and so therefore bonds makes sense as a place to be. And then, but we're going to have to reevaluate that view once we see what central banks do. If the downturn I'm expecting does come, and central banks and governments, how do governments react? That'll be the real key as to whether you want bonds are there for a longer term holding, or whether you need to sort of rethink.
And are you going for Aussie bonds or US bonds and corporates or treasuries?
So Aussie bonds. So there's I've got a couple of different views on this bit. I'm screwing off the edge of the screen here. So on let's take international bonds as the first point. So if you invest in an international bond, say a US or a UK bond, you're buying a similar bond to what you get in Australia, but now you've just got currency exposure as well.
Yep.
And currencies are volatile. And so if I'm going to get a 3 or 4% return on bonds, I don't want the volatility of currency on that. So what people do is then they go and hedge that out. And that's where a lot of arbitrage profits effectively comes from in the foreign exchange market, is basically people buying one bond in another country and going short, buy a US bond and go short an Australian bond, and then hedge the currency so that you pick up this small profit, and then the prices move a little bit and you undo the trade, and then the prices move back the other way, and you're all making sort of just tiny little parts on just massive amounts. And so the net effect of that, though, is if you actually go and buy US bonds and you hedge them, the return is actually not very different at all to just buying Australian bonds, except the problem comes that if a country gets into trouble, and maybe the US is, they're talking about defaulting. That's the Republicans say they're going to default. The thing that governments almost always do when they default, though, is they don't default on local people. Their first port of call is to default on foreigners, because let's face it, who cares if they don't get their money, is the sort of view about it. If I'm going to default, let me do that. They don't vote. So the long story is, if you've got invested in foreign bonds, you're going to get a pretty similar return to what you're going to get in Australian government bonds, but you've got an increased risk of default versus the Australian ones. Okay, so that's one side. Corporate bonds are a different thing again. So first of all, they're much shorter in time frame, so you don't get the same duration issue. But also, if you do go into a downturn, now you got to worry about defaults, and defaults spike in downturns. And actually, I think I've got a chart in Europe as a good example. The bankruptcies in the fourth quarter have just rocketed. So in the third quarter of 2022, they were basically back to where they'd been sort of pre-pandemic. It's the yellow line on this graph. And then in the fourth quarter just jumped, 20-30% higher. So, if you're going to invest in corporate bonds, you're going to worry you might not get all your money back. And so that they're not generally a safe bet if you're going into a bigger downturn. So the bonds I'm talking about, Aussie bonds, generally, I'm more interested in the longer duration stuff. But if you're worried about interest rates going higher, then you'd want to be just in the shorter duration.
No, that's very interesting, and the exchange rate risk is fascinating at the moment, right? I mean, I've been watching the UK, particularly. I have a certain interest.
Yeah, that's right.
Now, it got above 57 the other week, and I thought that was a pretty good rate, so I chucked some funds offshore in the UK. It's now down to 55 and a bit, right? And that movement, when you're handing a reasonable number over there, it can make a big difference. It really can.
Oh, absolutely. And just the rate you transfer it at as well. I mean, that's one for there was a group, I won't name any names, but there was a group doing free trading for the US in US stocks out of Australia, and you're like, that was, how are they funding that? I'll tell you how they're funding it. They rip you off blind on the currency trade. Saying, yeah, Martin, I've just saved you $10 on your US trade because you got to do it for free. It cost you $600 in extra currency costs, though. But but don't worry about that.
Correct.
So yeah.
Well, I learned an interesting lesson because the rate that was sort of readily available to me, particularly with the online transfer, was pretty bad, right? But I made a fuss and managed to get a wholesale rate, which saved me quite a lot. And they've now actually jigged my account so that I maintain that wholesale rate next time I actually move money. But you have to ask. If you don't ask, guess what?
Yeah, exactly.
They just help themselves to quite a lot more, right? It's very interesting.
Yes. Yeah, no, absolutely. I find, currency is
opaque.
Opaque. They make truckloads of money on it. That round trip, it'd just be, if you had to transfer money into one currency and then back again. So, I mean, and we do a lot of transfer within our trading. So through different groups, and everything gets done at wholesale rates, and it's pretty reasonable. Like, because there is, every day there are trillions of dollars. Well, maybe not trillions, but yeah, certainly every month there's trillions of dollars moved around in currency markets. Every day there's billions of dollars. And so it's very, very liquid. There's no reason why the banks, except for profit reasons, why the banks, don't need to take those big margins. And so, yeah, absolutely. Doing any big transfers or even just purchases overseas, like if you have regular overseas purchases, like we pay, tens of thousands of dollars for, Yeah, so I know one data provider in particular. I pay $25,000 a year US for data, and I know if I just the ordinary bank versus going through somewhere special is almost $1,000.
Absolutely,
extra cost to go just with the raw bank.
Yep, shop around. Now let's talk about superannuation next, because of course there was a big news item today with regard to
a week. Yeah.
Well, the last week, but the release today is 3 million is the cap. Above that, they're going to effectively charge more. Although, of course, they're not going to do it till 2025 after the next election, and they're claiming that there's only about a few thousand people who actually have very large superannuation balances, but one has, huge amounts, millions and millions and millions, right? And basically the philosophy is superannuation should be about securing a safe income in retirement. It shouldn't be an investment vehicle. What's your thoughts on all this? And I want to just mind taking around. I have to say I've felt all the way along superannuation is a bit of a con, right? Firstly, because of course years ago the risks were either taken by the government or indeed by final benefit schemes if you had an employee. Now the individual risks are with the individual. Secondly, you're forced to put it into it. Thirdly, there's loads and loads and loads of fees. It's not transparent, and they keep messing with it. Apart from that, it's a great investment.
Yeah, that's right. Well, I mean, it's a great tax credit, a great tax concession. Yeah,
well, it is, but they're saying it's going to cost more than the whole pension scheme in a few years'
Absolutely.
time. 50 billion or something.
I've got a chart up here showing this is numbers from the Treasury, just going. So the blue line is the cost of the age pension, the red is the contribution concessions, and the purple is the tax concessions on the earnings. And yeah, we're basically giving away more in tax concessions. So basically, if you didn't give the tax concessions, you could double the age pension at the moment, and you'd be net equal. But that, what that doesn't count as well. That doesn't count for all the fees.
Yep. Like
as you said, okay. So I don't want to say, look, I run superannuation, so we do more superannuation than investments. Most investment managers do. I think, I don't know, maybe 60% of our business is superannuation and SMSFs, and the other 40% investment, or something like that. But it's pretty similar amongst most investment advisors. Yep. And so my vested interest is telling you, Martin, you're crazy, Martin. This superannuation is the best thing ever. It's not. Like if you added the fees onto this as well, and the average fee I think is when you add it all up, it's pretty close to 1%. You go again, like the age pension gets up to another You double it by getting rid of these earnings conditions. You could add another 20 or 30% at least by getting rid of the fees on this, or centralizing some of the fees on these. So, is investing a good thing? Absolutely. I'm absolutely 100% behind investment. Is it right that that you should get some sort of tax benefit for for investing in long-term money and getting rid of the age pension? Yeah. I've got some sympathy for that. Should it be as extreme as what it is at the moment? No. And this is the most telling graph I think I've got, which is this is an estimate of from Treasury of the lifetime government support, and what it shows at that bottom, so it's different percentiles, and at the bottom end of the range, it's going, okay, if you're in the bottom 10% of earners, then you pick up all this money from getting an age pension, and then you get a little bit from contribution concessions and a little bit from earnings concessions, and that's your bar. And then you look at the 20th percentile, which is the next poorest group of people, and gradually that goes down, and you're like, yeah, that's what you want. You want that. You're giving the most support to the people who need it the most, and gradually, as you get higher and higher incomes, they get less and less support. But then once you get the 60th percentile, it goes completely the other way. Like you look at the the net benefit to somebody, the richest person in this, the richest 1% is almost $700,000 in net present value, and versus we're only giving the poorest people sort of 300, and you're basically saying, well, the richest people deserve twice the benefit out of this. And so I've got lots of sympathy for saying, and lots of sympathy for saying people should just pay a higher rate of tax, and when we're talking about a higher rate of tax, they're still giving a big concession. Like some of these ones where you're saying, like you could be earning, $1 million a year in your superannuation. At the moment, you're getting taxed 15%. If it was in your own name, you're getting taxed 50%. And what we're saying is, maybe you should pay 30% instead. And you're like, if it was in your own name, you're paying 50%. What are you squealing for about 30%? You're still paying almost half. So, I think there's I think there's a cap on. There should be more. And the real problem I thought with what the Labor government tried to do last time, and because the same applies to franking credits and other things like that also affect this, is that it's not about when they tried to do the franking credits, they tried to open it up to too many people. Now they're actually hitting these people in the 60th and 70th percentile that need the franking credits to help them get like that part of that benefit. But I think if you're, $3 million sounds fine as a starter. You start on that, and you should be gradually working its way down and back to a more reasonable level, or you leave it at 3 million, and in 20 years' time, that'll make up a lot more, a much greater proportion, or whatever it is of the population. But I think, just remember as well, it's not, you're not really taxing these people more. These are massive concessions over the ordinary worker. Yep. And I think there's a broader debate which everyone's too scared to broach in Australia, but because of what happened with the negative gearing. But it's a question about saying, well, should you actually say, even just separate, here's my investment income and here's my income from employment, and then let's have different tax rates on both. Because at the moment what's effectively happening is that investment side is taxed way less than the employment side. Yep. And is it a fair argument to say, here's somebody out slaving and working 3 jobs to earn $80,000 a year and getting taxed, whatever, and here's somebody getting $80,000 a year for investments and paying half the tax, a third the tax. Yep. So, yeah.
Well, it is interesting, and I did a radio interview today, which I think will go out tomorrow. We're discussing the generational issues here, right? Because there are quite a lot of younger people with very small superannuation balances, and I find it quite difficult to put anything other than the minimum in. And even if they do that, they're never going to get a huge amount, right? And then there's another group that actually seem to be able to put very large balances in and get huge tax benefits and breaks. So as that chart of yours showed, the benefits are completely spread wrong across the distribution, because effectively the people who actually don't need the benefits are the ones who are getting the most benefits.
Yeah, absolutely. And there was a lot of these ones where it's like, the spouse benefits and stuff like that. And you're like, yeah, you can throw an extra few grand in and get some credit back for your spouse. And it's like, well, that's fine if you're on $300,000 a year and you're like, yeah, sure, here's I'll give my wife $3,000 and double it or whatever. But the poor guy who's on, $60,000 a year with his wife at home with 3 kids is not turning around and saying, yeah, no worries, I'll take my spare $3,000 and toss it in. Yeah.
And the concept of superannuation is essentially a vehicle for income in retirement. In other words, it shouldn't be there for other speculative purposes or buying a house, etc., etc., etc. I mean, that's a bit of a political debate, but it's an important question, isn't it?
It is, and look, and part of the political debate is really coloured by. I sort of feel if the industry funds weren't dominated by Labor, then the Liberals wouldn't be as keen to rate it. They're quite keen on the tax benefits, not so keen on helping, the industry super funds, and I sort of feel, I think Labor's got that same sort of vested interest part. So, I guess in my view, there's a certain amount you should be. Look, I think it's fair enough to say for people's retirement, if they get self-fund it rather than having an age pension, then that's, yes, there should be some tax breaks, and yes, you should get that benefit. But you don't need $50 million or whatever it is, $20 million to fund your retirement. You can do it with a lot less than that. And so there should be sort of levels where you go, well, once you hit a certain level, fine, you can still, it's your money, you can still have it, but take it out of the superannuation system and just put it back in your own name. I mean, if you just went, if that was the question, if you just took these ones and rather than saying let's charge them 30%, you just said, oh, once you hit $3 million or whatever, take it out, stick it back in your own name, then now you're back in the normal taxation system. Yeah. But they're like, no, offer that, and nobody will want to do that. Everyone will want to be in the super where you get the extra concessions. So.
And of course, the other side of politics, we were talking about, election promises broken, etc., etc., etc. So it's become a political football. It will continue to be. But I mean, there is an important point of principle here, though, isn't there, about how you build security for old age and how you actually make sure that you've got a coherent investment strategy. And one of my observations is that many people really don't think about this until way too late. Yeah, well, that's right. And you do, look, the net effect is, and I guess where I was leading to with that as well is, superannuation is still, even under these new rules, it is still more favourably taxed than having the money in your own name. So, a lot of the ways people got this money into these superannuation accounts is no longer available. So Costello opened up a bunch of loopholes and then sort of even gave people forward notice of when they were closing the loopholes so they could pile as much money as they could into it. Yep. And so the days of people being able to funnel as much money into superannuation as what you used to are, well, they haven't completely gone, but but it's much, much, much harder now than what it used to be. Having said that, though, there's lots of different contribution strategies that make a lot of sense to people, and especially if you're close to retirement, you should speak to somebody about those strategies, and it might mean that there's just ways where you can start at certain ages you can start to draw down a little bit, but then put more in save more tax on your income and draw back out, or maybe live off your savings a little bit so you can actually put more money into your super at tax advantageous rates. So lots of little things you can do around that to benefit from those. And the net effect is, look, they're changing the rules. Absolutely, they look like they're going to change the rules, and the rules will probably change in the future. But will the rules change to the stage where they will be taxing superannuation worse than what they'll be taxing it in your own name? I find that impossible to believe. No, it's a relativity, isn't it? Right at the moment, we are at the extreme swing of the pendulum. It's a very generous tax regime. It's nonsensically generous, which is why, of course, people then put a lot of money in it. And Jason earlier on suggested we should try and figure out who that person is who's got the big arm. I'm not going to go there, but clearly it's someone with lots of money, right?
Yeah.
But the point is, even if you bring the pendulum back a little, it can still be a more, better point of leverage than actually not investing within the superannuation superstructure. But of course, people then get twitchy about, how much, if they change it, where could they change it to? And whose money is it?
I guess I'm pretty confident that you got spare $10,000 lying around. Do I put it into the super? Do I leave it in my own name? If you don't need this money and this is money for later, if you stick it in the superannuation and you invest in the same assets in both, is that you'll end up more by sticking it in superannuation because you'll be more favourably taxed than if you left it in your own name, almost every time. Sorry, as long as you're earning a reasonable income. If you're quite poor, actually, you could easily end up worse off. Yeah. And that's one of the strange things with the current system, isn't it?
Correct.
Is that you take somebody on $20,000, for example, who might be working a part-time job and say, Martin, I'm going to take $2,000 from you and I'm going to tax that at 15%. And you're like, just a minute, if I hadn't got it, I wouldn't have been taxed at all.
Correct.
Whereas the person who's on $200,000 and just earns another $2,000, he gets taxed at 15% rather than 50%. So,
and that crossover point, a lot of people don't understand it, which is a really, really important point to understand, right? Because you're forced into it, but there is a point below which it makes no economic sense, does it?
No, that's right.
Yeah. And just on the concession which are there, of course, the one that they've been amplifying slightly is the downsizer. So if you're at 55, you can put $300,000 into your superannuation if you sell down, right? As long as it's your own property, as long as it's not an investment property.
Now, I'm not going to stray too far into this one, but I will invite anyone who's interested in that to book a call with Sam, who's our financial planner, and he's the expert in that. But there's certainly there are lots of there's lots of little things they're doing with that are worth taking advantage of if you're in the right.
Absolutely. No, well, that one is one I personally have an interest in at the moment. So but talk to Sam and it is important to understand some of these things that are there, because quite often people aren't aware of them until it's too late. You've now got 90 days with this particular one, once you've actually settled, to be able to move it into a superannuation environment, unless you actually seek an extension. So it's a short window, but it's quite again, it can be tax effective depending on everything else. Yeah,
and look, I mean, part of the thing with I've seen various accounts that we've looked at who they're saving literally $20,000, $30,000, $50,000 in tax by just changing what they're going to do slightly. It's a question about saying, well, actually, if you sold this asset and this other one before you did something else, nets out the capital gains, and now you get into pension phase, and then you transfer this stocks in, and this quite simple things to do, and this is and as a for our clients, obviously we want to get the best effect for them, and this is this loop back, and in a way I feel bad about telling people there's a lots of these out there. Because the thing is, you want to take advantage of this thing. Yes. Absolutely, I want to take advantage of this.
Yes.
The problem is, and I encourage you to. There's no.
Well, it's perfectly legitimate, perfectly legal. It's been set up by government in this particular way. So make yourself aware of what those opportunities are and take them if you can. I mean,
exactly, and don't martyr yourself by saying no, I'm not going to take those. I'll let the government have it. If you're worried about that, then take the benefit and give it to charity, or give it to give it to a cause you care about. But because there is a lot of little things done in there, and unfortunately, as you said, a lot of it is for richer people or for people, retirees and retirees who may not actually need that extra support. But yes.
Now let's talk a little bit about the interest rate environment, and particularly bank deposits, right? Because there's been a lot of noise in recent times about banks not passing on deposit interest rate rises. They've been lifting the mortgage rates, and in fact the most recent reporting season that came out highlighted that the margins were actually being supported by those differentials. And then the government Chandler came out and said, please pass on more. And by the way, this is a global phenomenon, just not an Australian phenomenon, right?
Yeah, and it's not just this time as well. It's every time it's every time you see rates rise that it's Yes, very, very quick to pass on the rate rises on the mortgage side, and just a little bit slower, and actually not only slower, but also just don't pass on most of the rise anyway. There's the rates are much lower, and this is typical. Part of the issue is the banks don't really need the money. So you don't really get as much so you've got slowing loan volumes at the moment, so they don't need the deposits. Where they get more competition, ironically, is as the rates bottom as rates start to get cut, is like now our lending's actually getting lending starting to ramp up, and so now they want to chase more deposits so they can lend more money and fix some of their banking ratios, and so. So over the course of an entire cycle, it sort of eventually comes out. But you're right. Right now, banks are dragging the chain on it and paying quite low rates. And again, it's that problem with all these things is that, particularly banks, is that they rely on, it's a pain to change your banking. It is a real pain to change your banking. And so, and if you don't ask for the rates, then you won't get them. So similar with a lot of mortgages, if you don't ask for the special rate, then they're not going to offer it to you. You've got to get in there and chase it and ask. What else was going to say on deposits was.
I'll just come in. Because one thing I'm interested in is these special rates, right? So there are some headline rates that look quite good, but only for 3 or 4 months, and then it drops back to a very much lower rate. So if you're not careful, you can actually be allured into thinking this is a fantastic rate, but you've got to read the small print, right? And it's often the small print is not very clear to see.
Yeah, that's right. And so that whole part about, it's not an insignificant cost. Personal cost to go and I've got to go set up a bank account and get on my ID and whatever it is and change my direct debits or do whatever it takes to get it across. They will rely on you not wanting to do that very often. So we'll give you a quick short-term rate and then go from there. So I don't know what other tips I can give on that front. It's
No. Well, I keep saying I quite often run shows with the guy from CanStar, Steve Mickenbecker, and we often talk about this, right? Because we are still surprised how many people don't know what rates they're getting and don't actually check. And that's true for mortgages, it's true for savings. And there's something weird about the Australian psyche. It seems to me that we don't bother, and I'm quite surprised. I mean,
do the right thing though. We wouldn't have, Martin. Surely my bank would do the right thing.
You mean they'd ring you up and say, "Do you realise you can get a better rate?" when did pigs last fly?
Yeah, and I do have a feeling that there's that there's a little bit of turn taking as well. Is it you lower your rates to the cheapest. So the cheapest one around, or the cheapest in your cohort, you attract a lot of customers, and once you fill yourself up, then up go your rates again, and then until I need to do it again. So
exactly. So does that mean then the Australian banks are a good buy at the moment?
Good question. Okay, they are more expensive than they've ever been at the moment, relative to world banks. So we are off the charts in terms of how expensive we are. Now, maybe that's because the Australian economy will make it through much better. Like there is an argument. Some people go that China's booms, Australia's going to benefit the most. House prices will stop falling soon, and Australia's going to be really well positioned. The opposite position is, well, actually the China boom's not really on all base, and it's not really back into the building and everything like that. It's actually more, and actually China never really locked down that much anyway. Like they were actually pretty open relative to other countries, and so there's actually not as much to do in terms of that, and so it's not going to last as long. Australia's got some of the highest debt in the world. We've had some of the biggest interest rate movements. We've got more variable mortgages, so it's going to hit Australians much harder than elsewhere. And actually, the bad debt's going to be higher. And so, there's an argument that the Australian earnings are going to be worse. Another argument, which is is disturbingly, I feel disturbingly true about it. This is the one I think I because we've been underweight the Australian banks for a little bit now. And this is one I think where I could get it wrong, and maybe that Australian banks will justify how high the price is that there's an argument that banks are effectively just subsidised by our reserve banks and
term funding facility.
Yeah, and we've got APRA, and it's a closeness with the regulators that really is what really matters.
Yep. And
if you've got a nice close relationship with the regulators, then the banks can make much better returns than in jurisdictions where they don't have close regulators. So and that definitely seems true. Like if you look at, say, a European bank or a US bank relative to its Australian counterpart, it seems as if the Australian counterparts have got cozier relationships with the regulators, and so the regulators let them or approve of them making higher returns, or you get things like term funding facilities, and there will always be central bank support for banks. Like that's the central bank's job, is to support banks and make sure that the payment system's working. But it's a difference between saying I'm going to support them and I'm going to prop them up, or I'm going to help them, versus I'm going to give them way too much with the view that maybe I'll get a nice job there in a few years' time. And so that's the place. So yeah, I think Aussie banks look like they're in a dangerous position, and they're just more expensive relative to world banks than they've ever been. And so stay away. But the most likely reason I'd be wrong is that they just get more government support than other banks, and so they keep making great returns. And if
too big to fail,
and if things start to go wrong, then the red carpet's rolled out much faster and all the support's rolled out much faster here than elsewhere. And I hope I'm wrong about that, but I feel like I might not be. And that's it's a hidden cost we all pay, but it's
Well, you mentioned earlier on about lots of monopolies in Australia. I would argue that the oligopoly of the banking system is very protective of the profits of the banking system, right? So
yeah, absolutely.
Yeah,
absolutely.
And I remember talking to somebody who came out to Australia to start up a new bank. Came from the UK, and I was amazed at the margins that actually could be made here, right? But they didn't actually start up a new bank with much lower margins. They basically said, well, we'll just take them.
Right? Yeah, absolutely. If 80, 90% of the market is dominated by the four big ones and they can dictate the prices, then why would you? Yeah.
Why would you give it away?
Why would you give it away? Yeah, absolutely.
Yeah, it's very interesting. And, you mentioned the issues with regard to higher rates, the mortgage book. We've got the mortgage cliff. There's some different people saying different things about the impact of the mortgage cliff, but my analysis is still that there are quite a few people who are going to get flipped onto a higher variable rate in the next coming months, never mind interest rates go higher or not. So how does that then flow back into the property sector, right? Because we've seen property prices come down. What we're now seeing is, in some cases, property prices just going sideways, or maybe even ticking up very slightly. But there are some brave souls saying, no, this is the bottom.
Yeah.
What's your take on all that?
Oh, look, the affordability is still, as bad as it's ever been across a whole range of different measures. So, so I mean, that's I look at it mainly through that lens, and so I look at the mortgage costs relative to rent costs, with a view that there's that switching part. Mortgages get too expensive, then people go and rent, and mortgages get too cheap, and they go back and buy. And then your mortgage cost versus income, and both of those are at levels that in most major cities, excluding Perth. Perth's a little bit expensive, but not terrible. Whereas every other one is almost at record highs or at record highs. And so, it's an affordability issue, and it's hard to see how that's going to. You basically need now other rents to keep growing at rates that are 10% per annum plus, I guess, in terms of rents, which tends to, in the past, mean that you get you start getting that big. We've spoken before, and just for anyone who hasn't before, my view is that the housing market is so big in terms of there's 10 million odd houses out there, and it doesn't take much in terms of the number of people to much change in terms of the number of people per household to actually free up a lot. So if you go, I should have these numbers at hand. I can't remember the exact numbers, but you can basically change it in the second decimal place. You can go, okay, well, if you end up with 2.35 people per house rather than 2.44 or something like that, it just makes a massive difference in terms of that annual number of houses needed. And so a few people with extra flatmates, a few more kids staying at home for a little bit longer, and all of a sudden there's all this spare property. And vice versa, when a few people with less flatmates and a few more kids moving out earlier, and all of a sudden all the excess property you thought was there, disappears really quickly. And so, I think of those short-term ones as being very much an economic factor, as opposed as in the long term, it'll supply and demand characteristics will come out, but I think the economic factor of what people can afford to do, sort of in the short term, pushes out the fundamentals of have we got too much or not enough.
And you touched on the rental situation, which is disastrous at the moment. I'm seeing significant numbers of people being confronted with 15 to 20% increases in rent at a time when they can't afford it, but the owner of the property has seen their mortgage go up, and they're trying to square that circle. I mean, we've dug ourselves a really complex hole here.
Well, and it's not that complex. We've just opened up our immigration back to record levels.
Yeah, 500,000 or something is the likely number.
Yeah. And I mean, there's a big wave of completions coming through.
Yeah.
But there's a pretty big hole actually in the property in the next phase after that, particularly in the apartment market.
Yeah, the approvals have really dropped off, haven't they? So there's a range of completions taking a lot longer because they can't get the parts and they can't get the labour. But once they're completed, there's going to be a really big problem.
Yeah, so you get sort of that 3 to 4 years for apartments, and the sort of the idea was that, well, so 3 to 4 years ago was start of the pandemic, and so you didn't get a lot of new things start around that time period, and so there's a bit of a hole coming in terms of demand, in terms of the supply side, and at the same time we're running record immigration rates and wondering why rents are going up, sort of, so.
It's quite logical, really, but it's painful. And again, in my surveys, I see a lot of people in rental accommodation who are really stuck. There's no simple solution to their problem, short of moving a little further out.
I need to start a what do you call it? A cause for. I've sort of changed my view over time about this. I used to think, if we fix some of this negative gearing, get rid of some of the tax concessions and all that type of stuff, that'll help a lot of the affordability issues and sort of bring it back.
The rental crisis.
And that's never. The reality is though, it's not going to happen. It's not going to happen anytime soon. Like we had a government 3 years ago have a go at it. 4 years ago, an opposition 4 years ago have a go at it and not make it. It'll be 15 years before somebody's got the guts to try a change to that again. But what I'm thinking is we've got this new discussion, the housing hedge fund. I can't remember what their exact name for it is. Actually, what's the?
This is the 10 billion, right?
Yeah, Housing Australia Future Fund bill.
Sounds politically interesting, but actually practically useless. Yeah,
that's right. So basically, they're going to give $10 billion to investment managers and take the profits and put it back into housing or something like that. I mean,
I wonder what fees the investment managers will make. Oh, sorry, should I say that?
Yeah, it's a future fund, so it's not too bad. It's it's owned by that, and Costello's the chair. So there's lots of political people on that. Anyway, but let's outside that. I actually wonder whether we wouldn't be better off just saying, and it comes back to that talk about the amount of vacancies and everything like that we have.
Yep.
Is it maybe what we really actually need is property out there that can be government built or supported in some way, but it's actually just there to rent and it's not there for any other purposes. With the view that maybe we could drive rents down. Maybe we can't get property prices down because there's so many vested interest and all that type of stuff. But maybe actually we could get rents down to a reasonable level so that so you didn't have those. And I guess the idea behind that is that I think there's a bit of a problem in that. The more I consider the problem is that as societies get wealthier, like most people, once they get richer, they want to have more than one house, and they want to get and the really rich then go, oh well, I'll have a house here, and I'll have an apartment in the city, and I'll have a beach house, and I'll get one near the snow as well, and effectively, and I'm rich enough that I'd prefer nobody else goes in them, so I'm not going to rent them out. And even if you did, even if you are renting them out on an Airbnb basis or whatever it is, you're not actually, there's no one living in it. It's not like you've taken away. All you're doing is helping the people for holidays. And so, as we build more houses, we then also, if society's getting richer and richer, we're also taking more and more houses out of the pool, because it's like, well, more people. So anyway, I just sort of come down to maybe if there was a pool of houses that were only available for renting, Airbnb actually makes the problem worse as well in that same way.
They do, yep.
In that you've effectively taken a house out of the rental market by turning it into an Airbnb, and it's great you can rent it for holiday makers, but you've lost a place for somebody as a permanent home. And so anyway, I'll get more into that, but that housing future fund one is hot air, and it's not going to help.
It's political spin.
Absolutely.
So we're sort of coming towards the end, but there was one other question which came in. This is from Cross-Stitch Ange. Do you think what about in the world of essential workers, nurses, childcare? Should they have a differential interest rate? Should there be some concessional structure to help them? It's an interesting question.
Yeah.
Where does that lead us?
Yeah. Look, I think in a perfect world, I'd prefer we just pay these people better. So that'd be my solution to the problem is because I think that it starts to get, once you start doing that, it always becomes difficult, and everyone loves the rort. And so what was the one I looked at was car leasing is a good example. So basically, if you're in some not-for-profit sectors, then that you can get these tax benefits where your employer packages up part of your salary, and so rather than sort of going and getting a loan and then paying it for it, you can actually have it packaged and you get it on a pre-tax basis, and it's quite beneficial and all that type of stuff. The leasing companies that do it take more than, in some cases, in the ones I've looked at, take more than 50% of the gain. And so what happens is, you're like, whatever it is, it would have saved you $2,000 a year by doing this.
Yeah.
And here's this one who's packaged it up really nicely and made it all nice and easy for you to do, but you're getting like a $700 gain out of it, and they're making $1,300 a year. And so I don't know. I guess that's what I worry about, is that once you start doing special things for it, then all of a sudden everyone starts to redo the way they employ people, and there's middlemen emerge everywhere whose job is to basically get you into that, to get particular people into those rates. And so, I guess could you do something under the tax system where you give them a different, some beneficial ones on the similar basis? Yeah, maybe that's a better choice. I think my solution though is more, well, we probably should be paying them more, is one step. But the second thing is, I think if we could drive rental rates down by government support and getting more, keeping that, you cannot rent this out as an Airbnb, you have to live in it, and you cannot own 3 other homes and also rent this thing out. You got to, this can be your only, and you just use that to drive rents down, then that would benefit people more, because, maybe at a certain stage, if the way society wants to be is that house prices are eye-wateringly high, but rental rates are reasonable, then maybe it is fine for people to say, okay, I'll rent for my life. I'll spend a lifetime renting, and I'll actually save money over the long term. But at the moment, the problem is we've sort of ended up, as you said, in the worst of both worlds. We've got quite short rental terms in Australia, and it's subject to economic vagaries, and usually a lot of the landlords are only, 1 or 2. They're quite they're people, just ordinary citizens as well, who are trying to make money from this, and so that can affect markets.
Absolutely. Well, it's an interesting conundrum, and I'd add something else in there, and that is vacant properties. There are lots of properties across Australia that nobody ever lives in. Quite often, these high-rise apartments were bought new. They've never been occupied.
Foreign investors who
just sitting there rising values.
Yep.
So I will be looking at, and I know everyone says, there's always a million properties spare in Australia, but the census shows. But there are hot spots, particularly in some urban centres, where if they seriously wanted to provide a flow of accommodation, maybe to meet the essential workers, that would be a significant way of doing it.
Well, and also it's also this point about saying if you've bought a property, so let's say you're somebody in Hong Kong, and you're like, I want somewhere to go if it all falls apart. So I'm going to buy this property in Australia, and I've bought an apartment, and I'm not going to live in it. I'll pop out there, I'll pop out there for a holiday every now and again, but it's just going to sit there, and I don't really want somebody else living in it. I'm happy to have it there as that's my bolt. Now you've paid your stamp duty up front. But you're not actually paying any taxes in Australia, and we're supplying, we're supplying hospitals near that, and schools, and roads, and all these other things like that. And if you're only popping in, once a year for a visit, then it's actually just it's actually more of just an argument saying, well, if somebody was living in that, then they'd be paying taxes, and that would benefit, that would pay for all these things. And so maybe it's just a question of taking all these empty apartments and saying, well, maybe we do need to tax. There's some sort of bit. If you're not otherwise paying taxes in Australia, maybe you should be paying, a higher rate of tax on those so that we don't have all these apartments sitting there empty, or at least if they are, there's extra revenue coming in that we can use to go and build something else for other people.
Absolutely. Well, we're coming to the end of the show, so two things I'd like to hear from you before we close. Firstly, you've always said, you have a plan A, but you also have a plan B, and plan A goes wrong. So let's talk about plan A and plan B at the moment in terms of where the investment strategy is. And then secondly, just talk a little bit about Nucleus Wealth and what the World Funds and, the differential that you offer, because I think it's important people understand that not all super funds and not all investment managers are the same.
Yeah, absolutely. Okay, so the main thing, from a product point of view, the big thing I want to provide is transparency about what we're doing, and there's I just did a podcast recently on the whole idea of unlisted assets, and you put these into these funds, and nobody really knows what they're being valued at, and so there's another case where so what you're buying is you don't actually know what you're buying, and you're not quite sure what price you're paying for. Whereas with our funds, what we're showing is every single security you can see. It's you see it. They're priced. There's liquid markets for it. There's transparency. You can decide to cut things in and cut things out if you like. So if you're you don't have anything to do with carbon, for example, you can cut that out of your portfolio. You don't want anything to do with gambling, you can cut that out. So we tend to we want to let people have that, and we also want to tell you what we're doing. So that's the core tenet of it. Having a plan A and a plan B is so at the moment, my plan A is that I do think we're headed for recession. I think that central banks have overcooked it, and they're going to wait too long to reverse. Now, if I'm right, that's playing out over the next 6 to 12 months. We're going to see that come through, and it's particularly going to see is that earnings are going to keep falling. The types of stocks you want to own in that scenario is the quality stocks and what we call quality and defensives. So it's a mixture of stocks that things like consumer staples, like your everyday goods that people are going to, if you go into recession, people are still going to have to buy, and they might actually end up eating more at home or doing things like that. So stocks that will benefit from those types of factors, and the quality stocks who can hold on to their margins. So the ones that I spoke about who don't need to, they might have put their prices up and they don't need to cut their prices when because of competition, they're not facing the same things, pressures as some of the other companies that will have to cut. So that's a plan A. Now the question is, where are we going to be wrong on that? Are we going to be wrong because there is no landing, so there's no landing views, right, or there's a very soft landing, and interest rate rises don't end up causing the problems and the lag effect, and in which case then you want to be switching more into equities and more into growth assets. So that's one part of that. The other part then is, well, could central banks actually go too far and do what they say they're doing and actually drive us into quite a deep recession? Now, that bit I'm not as concerned about, because I think our assets are sort of set up for that mostly already. If we really think they're driving into a deep recession, we'd change more and we'd buy even less equities. But given we've just had a pop in equities at the moment in terms of prices, we've sort of pulled back again. And if they fall, we'll reweight a little bit more and buy a bit more with a view that, look, maybe things will be a bit more benign. But it's more of a matter of trying to work out, on that pendulum, what's the most likely, what are we positioned for, and then what are markets pricing in. And so right now they're pricing in, a pretty good outcome for equities. Bonds are pricing in we're actually sort of more comfortable with what bonds are pricing in terms of the outlook. And so, so does that answer it?
Yeah,
so it's a little bit.
No, yeah. I mean, you've highlighted, the dilemmas that you face. But there's one other point which I want to underscore, because it's something which I still find people don't get, and that's the concept of compounding. In other words, time in the market. Actually, it's really, really important, isn't it?
Yeah, that's right. And part of this is the idea that, look, no one's ever going to be 100% right or 100% wrong. And so generally markets will go up. There's a few studies about saying, should you average your way into it, or should you just dump all your money in on one day? And the answer is actually, you should just dump all your money in one. Markets on average go up, so you should just dump all your money in one day and hope you get one of those. Hope you come up at a good time. But it is that idea that, look, the game, if you're investing, the game is rigged in your favor. Over time you'll make more than than sitting out, and taking on a bit more risk is, over a longer period of time will be beneficial to you. These times, really, for me, in terms of the stocks that I'm looking to do, is really about getting a solid view on where are the really high quality stocks that, as prices get pushed down, you can buy it at prices you just won't see again, and you can start loading up on some of the highest quality stocks when they get beaten down in prices. And that's what I'd be looking at. If we're right and we're headed into a further downturn, that's the key, is grabbing those stocks now. And then, because the other stocks, the value stocks or the growth stocks, they're more for your trading. You're into the stock, and then you start reaching the end of the cycle a few years later, and you're selling out of those ones. Versus the really high quality stocks you want to grab, stick in your bottom drawer, and own them forever, so to speak. They're the ones which right now is a matter about getting that as a shopping list, and then as the prices are falling back, and saying, okay, that's the price I want to buy that stock at. Absolutely, and keep an eye on it and monitor it, and don't just set and forget, right? Because things change. Yeah, absolutely, things change. Well, Damien, thank you very much for your time tonight, and for the last few months. We won't do a show in a month's time, but we will do a show in 2 months' time when I'm in the UK, right? So I'm still planning to do these same live streams at the same time, Australian time. It'll just be a different time in the UK. So I'll look forward to the slightly more long distance conversation, but nevertheless the same sort of conversation, and still very interested in, we're focusing in on the Australian markets, but also a bit of context around the UK probably is going to be quite interesting too. So I look forward to that. And if people want to find out more about what World Funds, which are powered by Nucleus Wealth, or indeed Nucleus Wealth, we put the links and things below. And I really appreciate your time tonight. Thanks a lot, Martin. Best of luck with the move. Thank you. Yeah, we'll talk again in 2 months' time. Look forward to that. Thank you very much. I'm going to take you offline, and then we'll close the show. See you later. Bye. See you. So there you go. Thanks to Damien for his time tonight. And I just wanted to acknowledge specifically Alexander, who made a super chat contribution earlier on. Thank you, Alexander. Really appreciate it. And with regards to my own plans, check out my recent show, So Long Thanks for All the Fish, if you want to know more about that. But just
over the next few days, there will be a few extra shows. So next Monday at 8 p.m, so a day earlier, I've got Tony Locantro coming on the 6th of March. We're going to call that show Keeping It Real, so that's 8 p.m. And then the following day, on the Tuesday, which will be effectively a week tonight, I will be doing my final fling here with regard to live streams. So that'll be the last show in this series. And then I will be off air for about 4 weeks or so, maybe slightly more longer than that, with my normal sequence of shows. I will still, from time to time, pop up with little, short handheld recordings and things as I do what I do, but I need to take the studio down. It's going to take some time, pack everything up, get across the UK, get settled in over there. So I just want everyone to understand that this is not the end of Walk the World, nor indeed necessarily OTP. Well, different conversation on that, but it will be a slightly different context because I will be in a different geography for a period of time. And if you want to know more about that, see the property that I bought in the UK and the environment that I'll be in, it's all on that other show, so go check it out. But I want to say thank you to all of you who've spent time with me over the last few months and years on these Tuesday shows. Join us next week for those last 2 special shows. There's also a special show with Tarek this Friday, which will be a recorded show. But if you want to go onto Twitter, you can actually throw a question at Tarek there, and we'll try and cover that in the Friday show as well. So thanks very much. Have a very good evening, and keep following the channel, keep subscribing, and you'll be able to get alerts when I pop up. And as I say, once I've moved, I will be back and talking about the same old stuff, plus a few other things. We're going to roll out the survey, the household survey in the UK. That's one of the reasons I'm going over there. And I've got a few other plans, which I'll talk about more later. So thank you very much. Take care. And before I go, of course, we have to just do a quick visit to the doggies. They haven't moved very far. They've wandered around a bit, but not very much. So they're there. And the good news is, for those who may not know, I'm taking the dogs to the UK. So we will still have Doggy Cam UK style in due course. So thanks very much. Take care. Have a good evening. And I'll look forward to seeing you on the next show. This is Martin North from Digital Finance Analytics signing off. Cheerio.